Imagine this: you've worked hard, saved diligently, and now you're sitting on a $500,000 portfolio. But here's the million-dollar question: how do you make that wealth work for you? How do you transform it from a static number into a dynamic, income-generating machine? This is where the game changes, where strategy beats stagnation, and where you take control of your financial destiny. Building a portfolio worth $500,000 is no small feat. It speaks to years of dedication, discipline, and sacrifice. But now, the real work begins, making that portfolio generate consistent income so you can live your best life. Whether you're looking to retire early, achieve financial freedom, or simply enjoy the fruits of your labor, the strategies I'm about to share will revolutionize how you view wealth management. This isn't about keeping your money parked in low-yield savings accounts or blindly chasing high-risk investments. This is about being intentional, informed, and aggressive in pursuing income streams that align with your goals. Today, I'll reveal 7 powerful income ideas tailored for a $500,000 portfolio that are grounded in the latest financial trends and opportunities. Let's get started. At the top of our list we have dividend-paying stocks. The classic still deliver dividend-paying stocks have long been the cornerstone of successful income-focused portfolios, and for good reason. They combine stability, consistent cash flow, and long-term growth potential, offering a trifecta of benefits that few other investments can match. If you're looking to build a reliable income stream from your $500,000 portfolio, dividends should be one of your first considerations. Let's dive deeper into why dividend-paying stocks are so effective, how to identify the best ones, and specific strategies to maximize their potential in 2025 and beyond. Dividend-paying stocks are fundamentally tied to a company's profitability and financial health. When a company chooses to distribute a portion of its earnings to shareholders as dividends, it signals confidence in its future cash flow and profitability. This makes dividend stocks particularly appealing during uncertain economic periods or when market volatility is high. Additionally, dividends provide a hedge against inflation. Unlike fixed income investments like bonds, which may lose purchasing power over time, dividends tend to grow as companies increase payouts. Historically, dividend-paying stocks have outperformed non-dividend-paying stocks, especially during periods of economic instability. Dividend stocks provide regular cash payments, often quarterly, giving you a steady income stream without having to sell your investments. For a $500,000 portfolio, a 3% average dividend yield could generate $15,000 annually in passive income. Reinvesting dividends can accelerate portfolio growth through compounding. Dividend reinvestment plans, DRIPs, automatically reinvest your payouts into additional shares, increasing your future payouts. Over time, this snowball effect can significantly enhance returns. Qualified dividends are often taxed at a lower rate than ordinary income, making them a tax-efficient way to generate income compared to other sources. Dividend-paying companies are typically well-established, with strong cash flows and robust balance sheets. This stability often translates into lower stock price volatility compared to growth stocks. Let's talk about what to look for in dividend stocks. Dividend yield. This is the annual dividend payment divided by the stock price, expressed as a percentage. While high yields are tempting, be cautious. Extremely high yields may indicate a struggling company. Aim for yields in the 2%-5% range from reputable companies. Dividend growth rate. Look for companies that consistently increase their dividends over time. A steady growth rate indicates financial health and a shareholder-friendly management team. Dividend aristocrats, companies that have increased dividends for at least 25 years, are prime candidates. Payout ratio. This is the percentage of earnings paid out as dividends. A payout ratio below 60% is generally considered healthy, leaving room for reinvestment and growth. Sector diversification. Different sectors perform better in varying economic conditions. Diversify across sectors like consumer goods, healthcare, technology, and utilities to reduce risk. Economic trends. In 2025, focus on emerging trends like renewable energy, 5G infrastructure, and artificial intelligence. Companies in these sectors may provide both growth potential and stable dividends. Top dividend sectors and companies to consider in 2025. Consumer staples. Companies in this sector provide essential goods and are relatively immune to economic downturns. Examples are some examples: Procter & Gamble, PG. Known for its wide range of household products, PG has a long history of consistent dividend growth. Coca-Cola, KO, a global brand with a strong dividend yield, benefiting from its extensive market presence. Utilities. Utilities offer stability and reliable income due to their essential services. Here are some examples. NextEra Energy, NEE, a leader in renewable energy with a growing dividend. Duke Energy, DUK, provides steady income with a focus on clean energy initiatives. Technology. Traditionally a growth sector, some tech companies now offer dividends as they mature. Here are some examples. Microsoft, MSFT, combines dividend payouts with capital appreciation potential. Cisco Systems, CSCO, offers a strong yield with consistent dividend increases. Healthcare. Healthcare is recession resistant and poised for growth as populations age. Here are some examples. Johnson & Johnson, J&J, a dividend aristocrat with diversified revenue streams. Pfizer, PFE, combines a solid yield with opportunities in pharmaceutical innovation. Real estate, via REITs. Real estate investment trusts, REITs, are technically not stocks but can be included for their high yields. It is important to mention the company, Realty Income Corporation, known as the monthly dividend company. Let's talk about some strategies to maximize dividend income. Dividend reinvestment plans, DRIPs, automatically reinvest your dividends into additional shares to harness the power of compounding. Over a decade, this can significantly amplify returns, especially during market dips when reinvested dividends buy more shares. Dollar cost averaging, DCA, invest a fixed amount regularly, regardless of market conditions. This strategy reduces the impact of volatility and ensures steady portfolio growth. Focus on quality, not yield. Avoid chasing high-yield stocks without considering the company's fundamentals. Look for stability, growth potential, and a reasonable payout ratio. Build a diversified portfolio. Don't put all your eggs in one basket. Spread your investments across different sectors, industries, and geographic regions to mitigate risk. Monitor and adjust. Regularly review your portfolio to ensure it aligns with your income goals. Replace underperforming stocks with better opportunities. Let's see the emerging trends in dividend stocks for 2025. Renewable energy. The global push towards sustainability is creating opportunities in clean energy. Companies like NextEra Energy and Brookfield Renewable Partners offer growing dividends while addressing climate change. Technology dividends. As tech giants mature, they're increasingly returning cash to shareholders. Apple, Microsoft, and Cisco are examples of tech companies that now offer competitive dividends. International opportunities. Don't overlook international dividend stocks. Companies in Europe, Canada, and Australia often provide higher yields than US counterparts. Look for global dividend ETFs to gain exposure. Let's break down how you could allocate $500,000 across dividend-paying stocks. Consumer staples, 20%, $100,000 focus on Procter & Gamble, Coca-Cola, and PepsiCo. Utilities, 20%, $100,000 invest in NextEra Energy and Duke Energy. Technology, 20%, $100,000 include Microsoft, Cisco, and Apple. Healthcare, 20%, $100,000 choose Johnson & Johnson and Pfizer. Real estate, REITs, 20%, $100,000 at Realty Income Corporation and American Tower. With an average yield of 3%, this portfolio could generate $15,000 annually in passive income. Reinvest dividends for compounding growth or use the income for living expenses. In our list of top 7 ideas we have real estate investment trusts, REITs. This is where income meets inflation protection. Real estate investment trusts, or REITs, are a powerful tool for generating passive income and protecting your portfolio against inflation. By investing in REITs, you can enjoy the benefits of owning income-generating real estate without the headaches of managing physical properties. For investors looking to diversify their portfolios and create a steady income stream, REITs are a proven and reliable choice. REITs are companies that own, operate, or finance income-producing real estate across various sectors. By law, REITs are required to distribute at least 90% of their taxable income to shareholders as dividends. This makes them a top choice for income-focused investors. Instead of directly buying properties, REIT investors purchase shares of a REIT and earn dividends based on the income generated from its real estate holdings. This could include rental income, lease payments, or interest from property mortgages. REITs are traded on major stock exchanges like regular stocks, making them highly liquid. Unlike physical real estate, which can take weeks or months to sell, REIT shares can be bought or sold instantly, providing flexibility and ease of access for investors. Why REITs are attractive in 2025. The appeal of REITs lies in their ability to combine steady income with inflation protection. Several reasons why they're particularly relevant in today's financial climate. Real estate has historically been a strong hedge against inflation. As the cost of living rises, so does the value of properties and the rental income they generate. This means REITs can help preserve purchasing power during inflationary periods. With their legally mandated high dividend payouts, REITs provide a dependable income stream. Yields for REITs often exceed those of dividend-paying stocks, making them an attractive option for income-focused investors. Real estate has a low correlation with other asset classes like stocks and bonds, which helps reduce portfolio volatility. By including REITs in your portfolio, you add a layer of stability and diversification. REITs offer exposure to various property sectors, including residential, commercial, industrial, healthcare, and data centers. This allows you to benefit from growth in specific industries without directly owning properties. The rise of e-commerce, remote work, and technological advancements is reshaping real estate demand. REITs in areas like logistics, data storage, and healthcare are poised for significant growth. There are a few types of REITs to consider. Equity REITs. These REITs own and manage income-producing properties. Examples include residential apartment buildings, shopping malls, and office spaces. Equity REITs generate income primarily from rents. Mortgage REITs, MREITs. These REITs invest in real estate debt, such as mortgages and mortgage-backed securities. They earn income from the interest on these loans. Hybrid REITs, a combination of equity and mortgage REITs. Hybrid REITs invest in both physical properties and real estate loans. Specialty REITs. These focus on niche markets like cell towers, data centers, or timberland. Specialty REITs can offer unique growth opportunities. Top REIT sectors for 2025. Industrial and logistics. The boom in e-commerce and online shopping has driven demand for warehouses and logistics facilities. REITs like Prologis, PLD, and Duke Realty Corporation, DRE, are leaders in this space. Data centers. As the world becomes increasingly digital, the need for data storage and processing facilities is skyrocketing. REITs like Equinix, EQIX, and Digital Realty Trust, DLR, are positioned to benefit from this trend. Healthcare. With an aging global population, healthcare facilities are in high demand. Healthcare REITs like Welltower, WELL, and Ventas, VTR, invest in senior living facilities, hospitals, and medical offices. Residential. Urbanization and housing shortages continue to drive demand for residential properties. Residential REITs like Avalon Bay Communities, AVB, and Equity Residential, EQR, focus on high-demand rental markets. Retail. While traditional malls have struggled, REITs focusing on essential retail, like grocery-anchored shopping centers, are thriving. Examples include Federal Realty Investment Trust, FRT, and Regency Centers, REG. How to evaluate REITs for your portfolio. When selecting REITs, consider these key factors. Dividend yield. Higher yields are attractive but may come with higher risk. Aim for REITs with sustainable yields supported by strong earnings. Funds from operations, FFO. FFO is a key metric for REIT profitability, as it adds back non-cash expenses like depreciation. Look for REITs with consistent FFO growth. Debt levels. REITs often use debt to acquire properties, but excessive leverage can be risky. Check the debt-to-equity ratio to ensure financial stability. Occupancy rates. High occupancy rates indicate strong demand for a REIT's properties, leading to reliable income. Management quality. A skilled management team can make a significant difference. Research the leadership's track record and strategy. Let me give you the strategies for maximizing REIT returns. Diversify across sectors. Don't rely on a single type of REIT. Spread your investments across multiple sectors to mitigate risk and capture growth opportunities. Focus on growth markets. Invest in REITs targeting high-demand regions or industries, such as data centers or urban residential markets. Reinvest dividends. Like dividend-paying stocks, reinvesting REIT dividends can amplify long-term returns through compounding. Monitor interest rates. REIT performance is sensitive to interest rate changes. Rising rates can increase borrowing costs for REITs, so monitor rate trends closely. Combine REITs with other income strategies. Use REITs as part of a broader income-focused portfolio, complementing dividend stocks, bonds, and other investments. Let's say you allocate 30% of your $500,000 portfolio, $150,000, to REITs, industrial/logistics, $50,000 in Prologis, PLD, data centers, $30,000 in Equinix, EQIX, healthcare, $40,000 in Well Tower, WELL, residential, $20,000 in Avalon Bay Communities, AVB, retail, $10,000 in Federal Realty, FRT with an average yield of 4%. This allocation could generate $6,000 annually in passive income. Reinvest these dividends for long-term growth or use them for expenses. Number 3 in our list of top 7 ideas are covered call strategies. This where you can have income from market volatility. Covered calls are an aggressive yet calculated way to generate income from stocks you already own. By selling call options on your holdings, you earn a premium, essentially getting paid for holding onto your investments. This strategy works best in a moderately volatile market, like the one we will be seeing in 2025. Choose blue-chip stocks or ETFs as your underlying assets for stability. With a $500,000 portfolio, allocate $100,000 to covered call strategies to potentially generate 1 to 2% monthly income. Idea number 4 in our list, fixed income investments. Yes, bonds aren't dead yet. With interest rates on the rise, bonds are making a comeback. Government bonds, municipal bonds, and corporate bonds offer predictable income streams with varying levels of risk. Look into TIPS, Treasury inflation-protected securities, for inflation-adjusted returns. For higher yields, consider investment-grade corporate bonds or high-yield bonds from stable companies. Dedicate 20% of your portfolio, around $100,000, to fixed income assets, balancing security with return potential. Idea number 5, peer-to-peer lending. Be the bank. Peer-to-peer lending platforms allow you to lend money to individuals or small businesses in exchange for interest payments. It's a high-risk, high-reward strategy that can yield returns of 6 to 12%. Platforms like LendingClub and Prosper offer diversified loan portfolios to mitigate risk. Allocate no more than 10% of your portfolio, $50,000, to peer-to-peer lending, and be selective about borrowers to maximize returns. Idea number 6: alternative investments. Exploring the unconventional. Alternative investments like private equity, hedge funds, and commodities are gaining traction as diversification tools. For a $500,000 portfolio, these assets offer both income and growth potential. Consider investing in precious metals like gold or silver, which act as safe havens during economic uncertainty. Or, explore niche opportunities like investing in fine art or wine through platforms like Masterworks and Vinovest. Allocate 10 to 15% of your portfolio to alternative investments for a unique edge. Last in our list of top 7 ideas for a $500,000 portfolio is high-yield savings accounts and CDs, a safety net that pays. Not every dollar in your portfolio needs to be at risk. High-yield savings accounts and certificates of deposit, CDs, provide safe, FDIC-insured returns. While the yields are modest, they offer peace of mind and liquidity. In 2025, many online banks could be offering competitive rates above 4%. Dedicate 5 to 10% of your portfolio to these options, ensuring you always have accessible cash while earning passive income. Personally, I prefer the first 2 in our list, dividend stocks and REITs, as I find them easier to manage, after you have done your own research. However, this is just my personal preference. To implement these ideas, you need the right tools and knowledge. Use investment platforms like Vanguard, Fidelity, or Robinhood for stocks and ETFs. For REITs and alternative investments, consider specialty platforms like Fundrise or Masterworks. Peer-to-peer lending? Stick with well-established platforms to minimize risk. I will mention it again, do your own research and start with what you are more comfortable with and consider the level of risk. You must have a budget. Don't put yourself in difficult situations. Let me be blunt, every day you delay implementing an income strategy, you're leaving money on the table. The financial markets are evolving rapidly, with emerging trends offering unprecedented opportunities. But here's the catch, these windows won't stay open forever. Whether you want to retire early, fund a passion project, or simply enjoy financial freedom, the time to act is now. Take control of your portfolio, diversify your income streams, and make your wealth work for you. A $500,000 portfolio is more than just a milestone, it's a launchpad for your financial future. With the right strategies, you can turn that sum into a reliable income machine, empowering you to live life on your terms. The 7 ideas I've shared aren't just theories, they're proven methods to achieve financial freedom. But remember, the journey to wealth isn't just about numbers, it's about mindset. Be proactive, stay informed, and never stop seeking growth. I hope you enjoyed this video. If you did, Please show your support by hitting that like button and subscribing to the channel. Sharing this video with your friends would also mean a lot. I'd love to hear your thoughts in the comments below. Your feedback helps me create even better content. Thanks for watching, and I'll see you in the next one.